There is a company no one elected, no one audits in full, and no government openly controls. Yet it effectively prints the liquidity that keeps crypto alive. It has issued nearly $187 billion in digital cash, earns over $13 billion a year, and quietly sits at the center of almost every major Bitcoin and Ethereum transaction. Tether claims every USDT is fully backed. History says otherwise. Regulators have already proven gaps once, and the system has only grown larger since. Today, more than 60% of the stablecoin market depends on this single private entity. That is not decentralization. That is a single point of failure hiding in plain sight. There is a pattern the market pretends not to see. Every time crypto needs oxygen, Tether appears. In November 2024, over just 5 days, roughly $5 billion worth of USDT was minted, precisely as Bitcoin began accelerating into a new rally. In December 2025, another billion was injected around year-end, exactly when liquidity was thinnest and sentiment needed a push. These are not coincidences. No one voted Tether into this role, no central bank charter exists, yet it effectively controls when leverage re-enters the system. This is not monetary policy by law. It is monetary influence by necessity. The deeper issue is incentive. Tether holds approximately $112.4 billion in U.S. Treasury bills. At prevailing yields near 5%, that position alone generates roughly $5.6 billion annually. The profits are extracted by Tether, not shared with USDT holders. From the user's perspective, USDT is marketed as stable, yet economically it behaves like a zero-yield deposit that subsidizes a private issuer. As one industry founder bluntly stated in 2025, Tether is literally printing money while holders receive nothing. This dynamic becomes more dangerous in a high-rate geopolitical environment. The Federal Reserve's elevated interest rates are not just a domestic policy tool. They are a global weapon that rewards dollar liquidity holders. Stablecoin issuers sit at the center of that transfer, but the cycle cuts both ways. When rates eventually fall, Tether's yield collapses. The temptation then is obvious. Issue more USDT to preserve profit levels. Safety becomes secondary to balance sheet momentum. Holding USDT feels passive, even prudent. In reality, it places you inside a machine designed to extract value upward. The question is not whether Tether profits from your capital. That is already proven. The question is what happens to the promise of full backing when the profit engine stalls. Concentration risk is the quiet killer of financial systems, and crypto is saturated with it. As of 2026, USDT commands roughly 60% of the stablecoin market, while USDC controls another 25%. That means 85% of crypto's transactional liquidity flows through just two centralized entities. Expand the lens further and the picture worsens. The top 5 stablecoins represent approximately 93% of the entire $232 billion market. This is not decentralization. It is fragility disguised as efficiency. Academic research has already quantified the danger. A National Bureau of Economic Research study estimates Tether's annual run risk at roughly 3.9%. Over a 10-year horizon, that compounds to nearly a 37% probability of a destabilizing event. Those are not fringe numbers. They imply that a large-scale liquidity shock is not a question of if, but when. The reserve structure amplifies this vulnerability. Out of more than $181 billion in reserves, only about $30 million is held as true cash liquidity. The rest sits in treasury bills, reverse repos, precious metals, Bitcoin, and increasingly controversial secured loans totaling $14.6 billion. In a mass redemption scenario, those assets must be liquidated under pressure. Forced selling of treasuries does not stay isolated. It transmits shock into traditional bond markets, raising yields and tightening global financial conditions. Layer geopolitics on top, and the risk compounds further. Between 2024 and 2025, U.S. authorities across the Department of Justice, Treasury, and FinCEN simultaneously scrutinized Tether. In sanctioned jurisdictions, USDT has already been frozen instantly without warning or recourse. When you hold USDT, you are not holding neutral digital cash. You are holding exposure to regulatory discretion and geopolitical escalation. If 85% of crypto liquidity depends on entities that can be halted overnight, the system's weakest point is already identified. Tether's transparency is theatrical, not structural. What it publishes are attestations, brief snapshots prepared by private firms, not full continuous audits subject to regulatory oversight. This distinction matters. In 2021, the New York Attorney General demonstrated exactly why. Tether was found to be backed by only 74% reserves at key moments, despite public claims of full backing. That was not speculation, it was a legal finding. Today, the same framework persists. Attestations are issued without SEC supervision, without real-time verification, and without detailed breakdowns that would allow independent risk assessment. Former regulators have been explicit. Without full transparency, there is no way to conclusively verify Tether's claims. Trust is substituted for proof. The most troubling element lies in the loan portfolio. As of late 2025, secured loans had grown to $14.6 billion, up from $10.1 billion just a quarter earlier. These loans were previously described as a temporary measure meant to be phased out, yet they continue to expand. Crucially, Tether does not disclose the borrowers, the collateral quality, or the terms. In finance, opacity is not neutral. It is a signal. Even reserve diversification raises questions. Significant allocations to gold and Bitcoin, alongside equity investments in media platforms and sports franchises, suggest preparation for scenarios beyond routine stablecoin operations. If confidence in fiat reserves were absolute, such hedging would be unnecessary. Instead, Tether appears to be building parallel stores of value and influence. Attestations function psychologically, not mathematically. They show users enough to feel reassured, but never enough to verify independently. That gap is not accidental. It is how confidence games survive, not by disproving doubt, but by managing it. Stablecoins do not fail slowly. They fail through confidence cascades. The collapse of Terra's UST in May 2022 demonstrated this with brutal clarity. A modest 5% depeg was sufficient to trigger a self-reinforcing spiral that wiped out tens of billions of dollars in days. The lesson was simple. Stability is not enforced by code or reserves alone, but by belief. Once belief fractures, math accelerates the damage. In a real-run scenario, arbitrageurs, the very actors assumed to stabilize the peg, become the first to exit. Redemption queues form instantly. If even a fraction of Tether's estimated annual run risk materializes, billions would seek conversion simultaneously. Tether would be forced to liquidate treasury holdings rapidly, pushing yields higher and tightening global liquidity. Each market reaction feeds back into the peg, intensifying pressure rather than relieving it. This is not a linear process, it is a cascade. Warning signals already exist. Tether's equity declined from $7.1 billion in late 2024 to $6.8 billion by September 2025, even as more USDT was issued. During the same period, over $10.4 billion in dividends were distributed, exceeding reported profits. That arithmetic implies reserves being drawn down to sustain payouts. Meanwhile, cash liquidity ratios have steadily declined, reducing shock absorption capacity. Regulation sharpens the blade further. Allegations related to money laundering, combined with tightening stablecoin frameworks across Europe, the UK, and Canada, create an environment where a single enforcement action could effectively freeze redemption pathways. In that scenario, depegging becomes instantaneous, not gradual. There is no deposit insurance here, no lender of last resort. If panic begins, it will not ask for permission. Stablecoin stability is not a law of physics. It is a collective hallucination. When the crowd stops believing, the break is violent. Tether is no longer acting like a simple stablecoin issuer. It is evolving into a vertically integrated financial entity. Beyond USDT, it has built exposure across Bitcoin mining, precious metals, real estate, and strategic equity investments. Media platforms, high-performance computing, energy infrastructure, and artificial intelligence are not side projects. They are pieces of a larger power structure. Liquidity, infrastructure, and assets are being assembled under one umbrella. This signals an endgame beyond transactional stability. By controlling liquidity while embedding itself across crypto infrastructure, Tether positions itself as a de facto central bank, financing miners, influencing platforms, and anchoring settlement. Power, once consolidated, rarely steps back. But sustainability is the weak point. Dividend extraction has accelerated while stablecoin liabilities grow. When payouts approach profits, reserves erode and the peg's buffer thins, regardless of narrative. Competition is rising, yet Tether's 60% market share means any transition would be chaotic. Add geopolitics, an offshore issuer powering dollar dominance, and the contradiction tightens. Tether began as infrastructure. It is becoming an empire. Empires either formalize power or collapse under it. The uncomfortable truth is simple. Crypto's main liquidity engine is a centralized, lightly audited private company under global regulatory pressure. Every stable trade is a bet on Tether's solvency, legal tolerance, and geopolitical standing. USDT is not dollars. It's counterparty risk dressed as convenience. This isn't a call for panic. It's a call for precision. Use USDT as a tool, not a vault. Watch the signals. Crises don't announce themselves. They arrive when attention fades. Subscribe to Underworld Capital. Comment if you still hold USDT and why.